Hello, good morning. Today I'm going to talk a little bit about the relationship between buying your first home and the taxes and eventually selling that home. I'm going to talk about what are some of the things you should be thinking about from a tax perspective. Start from the start. You're a first time home buyer, meaning you've never previously owned a property. Let's use 2020 for this example. So you buy your home, let's say in January of 2020. So in that year, when you file your taxes, the federal government has a thing called a first-time home buyer's credit. Essentially, what it is, it's a $5,000 non-refundable credit, which basically works out to $750 of amount you can use to offset taxes in that year. In our example, in 2020, it's non-refundable, so that means that you're not going to get $750 if you don't owe any taxes. It's something that just goes against your taxes. So if you don't owe any taxes that year, it doesn't benefit you that year. So in that process, let's say you need a down payment to purchase a house. So in Canada, you can take, I believe the amount is up to $35,000 from your RSPs to use, as a down payment to purchase a house, which is a very good thing, actually, right? But obviously, there's caveats on situations like this. So yes, you can take $35,000 from your RSPs. So if you are married or you have a common law partner, you guys can take up to $70,000. You do have to put that money back, right? Let's say you were taking out $35,000 from your RSP. You have 15 years to pay that amount back. Okay, and so in 2020 you took out the money. So basically it means that you have to pay this amount back by 2035. And there is a two-year grace period, so meaning you don't have to start repaying the amount back, in our example, until 2022. So then in our example, the full amount would actually be in 2037, right? Because it's 15 years after the repayment period starts, I believe. I'll have to double check on it. I'm not certain if it's 15 in total or 2 plus 15, but you can look that up, or I can look it up and let me know if you have questions about that. Now, what happens if you don't pay that $35,000 back, let's say in year 15? Now, it just becomes an income inclusion. Let's say, for example's sake, you're taking out the $35,000, but over that 15 years, you only manage to pay back $20,000, which means you're left with a $15,000 amount you didn't pay back to your RSP. Now, don't worry, the government is not going to come after you to give them $15,000, because remember, this was your money in your RSP in the first place. The only thing was it was not taxed. So that $15,000 just becomes an income inclusion in that year 15, since you didn't pay it back. So then you just pay tax on the amount. Let's say in that year 15, you had employment income of $50,000. Now plus this $15,000 just means that your total taxable income for that year, it's just it's $65,000, right? So you just pay tax on the amount. Now the third step in the process, let's say 10 years later, you've lived in this house, you and your spouse or common law, whoever, and this was the only home, so it's your principal residence, and you sell it. And over those 10 years, this house has increased in value by, say, $100,000. I'm not sure if that's a realistic number given the market we're in right now, but I think so. 10 years, you can hopefully make $100,000 in your principal residence. Now in Canada, normally taxable capital gains are taxed, right? And they're called taxable capital gain, right? In Canada, you're taxed on 50% of your capital gain. But when it comes to a principal residence, there's no tax on it, right? The only thing you have to remember in that year that you dispose of that principal residence, or which your accountant will remember, hopefully, is that they just have to indicate that, you did dispose of a principal residence and that you elected as your principal residence. What basically what that does is it makes it so that you don't pay any tax on the capital gain. So in summary, or to wrap up, so the three steps are: you're a first-time home buyer, you get a $5,000 home buyer's credit, which works out to $750 of non-refundable credit you can use to offset your taxes in that year. And remember, you can take up to $35,000 from your RSP. So if you're a couple, you guys can take up to $70,000 that you can use towards the purchase of your first home. And you have to pay it back within 15 years. And the repayment period doesn't start 2 years after you take it out. And if you don't pay back by year 15, it just becomes an income inclusion, which means you just pay tax on it. And the last process is you went and sold that home down the road and you had a capital gain on it. Just remember, assuming it was your principal resident, remember you're not taxed on that gain. You just have to remember to say that on your tax return that year that you dispose of a principal resident, so the gain is not taxed. So that is it. I thought that might be useful, because these are topics that I find myself I'm going to be doing myself here in the next couple of years. So I thought probably I have some friends out there who are probably in the same process if they've already done so, and it might be useful for them. So let me know if you have any questions, and have a good day.